Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into MediWound Ltd, ticker symbol MDWD, a fascinating biotech player that has built its entire strategy around a single, powerful piece of enzyme technology. MDWD is betting its government-backed $216 million BARDA contracts provide a secure financial floor, enabling the company to fund the pivotal EscharEx Phase 3 trial, which aims to capture a major share of the $2.5 billion chronic wound TAM by proving superiority over the decades-old incumbent SANTYL.
That thesis, it captures the fundamental tension here perfectly. And it is, it's just crucial for listeners to understand the structure of this proposition.
Right.
MDWD represents a really unique blend. I mean, on one side, you have these critical national security assets.
Which means stable government-backed revenue.
Exactly. Highly stable. It provides immediate financial and operational stability. But then on the other side, you have this massive high-risk, high-reward commercial opportunity in the world of non-surgical tissue repair.
Yeah. So our mission today is to figure out how that government money, how it serves as the foundation.
Yes. How that robust, non-dilutive government funding acts as the indispensable financial foundation, giving the company the stability and, the runway to pursue that huge leap into the lucrative but ferociously competitive chronic wound care market.
Okay, let's unpack this. We have to start with that foundation. Let's start with the flagship product, NexoBrid, and its really critical relationship with the U.S. government.
Right. So NexoBrid is, and I'm not using hyperbole here, it's the cornerstone of the whole MediWound enterprise.
Okay.
We're talking about a proprietary biological orphan drug. It already has full FDA and EMA approval. Plus, it's authorized in over 40 countries.
And its job is what exactly?
Its clinical purpose is simple, but the mechanism is revolutionary. The non-surgical enzymatic removal of Eschar.
That's the dead tissue on severe burns, right?
Oh, that's it. The dead, tough, potentially infectious tissue from severe thermal burns. And look, this isn't some theory. It's a validated global solution. It's already treated over 16,000 patients, and it's dramatically changed the standard of care for serious burn victims.
And that shift, that's a huge deal. I mean, traditionally, the only way to get that Eschar off was with a scalpel surgery.
It was. Traumatic, non-selective, often requiring multiple procedures. NexoBrid just replaces that highly invasive surgery with a simple, targeted gel application.
So what does the Phase 3 data actually tell us about how effective that switch is?
The clinical data? It's not just strong, it's genuinely dramatic. The Phase 3 studies showed NexoBrid achieved a 93.3% incidence of complete Eschar removal.
93%. And the control group?
The control group, which was just the gel vehicle without the active enzyme, achieved only 4.0% removal.
Wow. Okay, that's a stark difference.
It is. And the clinical result is even more compelling. The need for subsequent surgery, it just plummeted from 72% under the old standard of care down to a mere 4% with NexoBrid.
72 down to 4. That's the metric that's driving adoption, I imagine. But it also means huge economic benefits, less trauma for patients.
Exactly. And when you look at the pediatric population, the clinical superiority, it goes from impressive to genuinely transformative.
This is where it gets really interesting, I think.
This is where the product's true humanitarian value shines, and frankly, why governments started paying very close attention. For pediatric burn victims who are so vulnerable to surgical trauma and blood loss, NexoBrid offered a level of protection that just wasn't available before.
So what do the numbers show there?
The data showed it reduced the need for blood transfusions from 73% under the standard of care to a staggering 2%.
73 to 2%.
Mm-hmm. And what's more, the need for subsequent major skin grafting dropped from about 80%. 80.5% to be exact, all the way down to just 2%. It just preserves so much more healthy tissue.
That kind of efficacy, especially in kids, that doesn't just get the medical community's attention. That makes your product an indispensable part of what, national emergency planning?
Precisely. This is the moment NexoBrid moves from being just a biotech product to a strategic national asset.
And now we're talking about BARDA and the DoD.
Yes, the Biomedical Advanced Research and Development Authority, BARDA, and the Department of Defense. They see NexoBrid as a crucial strategic medical countermeasure. It falls right under Project BioShield.
Which is all about preparing for, the worst case scenarios, chemical, biological, nuclear threats.
Exactly. Severe thermal burns from a blast event, or chemical exposure like sulfur mustard. They require rapid, trauma-minimizing Eschar removal. That makes NexoBrid mandatory infrastructure.
Okay, and the government's money reflects this. We said in the thesis over $216 million in non-dilutive funding. Can you just break that down for us? What does non-dilutive actually mean for an investor in this case?
That distinction is absolutely crucial to the whole thesis. Typical biotech funding, it's dilutive. They sell off pieces of the company, which reduces the value of existing shares.
Right, they're giving up equity.
BARDA funding is different. It's a contract for development and procurement. It is essentially a secure, guaranteed revenue base from the government, valued over years. It provides cash for R&D, for manufacturing scale-up, clinical trials, all without issuing a single new share.
So it's security without dilution.
It's the ultimate operational hedge against the unpredictable, high-risk world of biotech R&D.
That sounds like an incredible safety net. But I have to ask, government contracts can change, right? If the big bet EscharEx were to fail, how safe is that floor, really?
That's a fair question. And if EscharEx failed, yes, the commercial upside story would evaporate. But the NYSE division, that government-backed floor, it would remain largely intact and continue to grow.
Why?
Because the government's need for this burn solution is totally independent of the chronic wound market. The funding isn't just for stockpiling, it's for critical development, like the prior BARDA contract worth up to $43 million specifically for use against sulfur mustard injuries. That ties the product to a specific long-term national security mandate.
And more recently, the DoD has been funding development for operational security for deployment.
Exactly right. The DoD awarded $3.6 million for a very specific goal, developing a room temperature stable formulation of NexoBrid.
Which sounds minor, but in practice is huge.
It has massive strategic consequences. In a disaster or a military deployment, you can't rely on refrigeration. A stable formulation ensures you can use it immediately, anywhere.
So the product is secure, but what about the supply chain? That's always a risk.
And that's the other part of this partnership. Supply chain resilience is paramount. Right now, MediWound has two problems. First, demand already exceeds manufacturing capacity by threefold.
4 times.
And second, their manufacturing facility is in Israel, which is a geographical risk. So BARDA is proactively funding the planning for a U.S.-based backup manufacturing facility.
Which is a huge vote of confidence, securing the supply chain on U.S. soil.
A major signal of long-term commitment. It removes that reliance on a single overseas site.
And in the short term, how are they dealing with that threefold demand surge?
They're in the middle of a massive expansion, a 6-fold increase in production capacity at their current facility. It's a huge project, expected to be fully operational by the end of 2025.
So if we just wrap up this first part, the government partnership is more than just a check. It's financial stability, operational security, and it's funding massive, non-dilutive infrastructure investments.
It creates that high-quality, government-backed financial floor. The strategic necessity of NexoBrid means there's a durable, long-term revenue stream underpinning the entire company.
And that security is what lets them go after the bigger prize.
It gives them the freedom and the capital to pursue the high-risk, high-reward ceiling that is their pipeline product, EscharEx.
Okay, so that operational success is locked in. It's the funding engine. But the core of both products is the same science. Let's dig into that. The Bromelain enzyme technology.
This biological platform is, it's really the key differentiator for the whole company. The entire story is built on this one validated discovery. The active ingredient, the API, it comes from a surprisingly natural source.
From a pineapple stem, right?
A proprietary bromelain concentrate derived directly from the pineapple stem. And this isn't, just some health food store extract. It's a highly purified, concentrated, pharmaceutical-grade product.
The idea of a pineapple enzyme being at the core of this is, well, it's surprising, but it's the mechanism that's revolutionary. You called it a super smart biological scrub. How does it know what to attack and what to leave alone?
That is the essential insight. The technology uses a complex mix of powerful proteolytic enzymes. They're engineered to target and break down specific denatured proteins, the stuff that makes up dead tissue.
But not healthy tissue.
Healthy, viable tissue is structurally different. It maintains its integrity. The bromelain concentrate doesn't attack it. That's the key. It's extreme selectivity. It selectively removes the non-viable tissue while leaving the healthy, viable tissue completely unharmed.
So it's like a set of molecular scissors that only cuts the proteins in dead tissue, leaving the living stuff underneath totally intact, which is obviously vital for healing.
Exactly. That's why it works so well in burn care. It clears the way for natural healing or grafting without the collateral damage of surgery.
Now, connecting this back to the investment case, this tech is the bridge between the secure floor and the massive upside. We have to talk about platform validation.
This is a critical factor for de-risking the pipeline. The core technology, the API, it's shared between NexoBrid for burns and the pipeline product, EscharEx, for chronic wounds.
And the formula.
The EscharEx formulation uses, and this is a quote, almost the same formula as the already FDA-approved NexoBrid.
And that has to fundamentally change the risk profile of the phase 3 trial.
It absolutely does. You have a powerful pharmacological precedent, the safety profile, the mechanism, the regulatory pathway. It's all largely known and accepted. They're not betting on some brand new, unproven molecule. They're just adapting a validated tool to a different, much larger market.
And that efficiency carries over to manufacturing as well, I assume.
Yes. A shared API is incredibly efficient. Both products come from the same CGMP-certified sterile manufacturing facility, the one getting that 6-fold scale-up. So one infrastructure investment supports two distinct multi-billion-dollar markets.
So if we look at the big picture, the investment case is stronger because they're not making two separate bets. They're leveraging one proven platform across two huge distinct markets.
It's an incredibly intelligent and integrated business model. NexoBrid proves the platform works, it generates the capital, and it lowers the regulatory hurdle for EscharEx. It allows them to focus almost entirely on proving clinical superiority in this new market.
That inherent safety and success gives them the confidence and the cash to go after a multi-billion-dollar market where the standard of care is shockingly old. This is where it gets really interesting. Let's talk about the opportunity in chronic wounds.
The chronic wound market in the U.S. is just staggering, not just financially, but in the burden of patient suffering. EscharEx is targeting enzymatic debridement for venous leg ulcers, VLUs, and diabetic foot ulcers, DFUs.
And the market size, the TAM.
The U.S. total addressable market for this segment is estimated at a colossal $2.5 billion or more.
Let's put that in context. Why are these wounds such a stubborn and expensive problem?
Chronic wounds are a systemic failure to heal. DFUs account for the bigger piece, about $1.5 billion of that TAM, with 2.2 million new cases a year in the U.S. VLUs are the other $1.0 billion, with 1.5 million new cases.
And they lead to terrible outcomes.
Infection, sepsis, amputation. The cost to Medicare for DFUs alone is almost $10 billion a year. So rapid, effective healing isn't just a clinical goal, it's an economic imperative.
And the critical first step to healing is always debridement, getting that dead tissue out of the way. But EscharEx is marketed as more than that, a bioactive multimodal debridement therapy. You called it a triple threat. What does that mean?
The triple threat addresses the three main obstacles to healing. First, rapid debridement with those selective enzymes. Second, and this is key, it actively works to stimulate granulation tissue,
Which is the healthy new tissue you need for the wound to close.
Exactly, the healthy, pink, vascularized tissue. And the third action is maybe the most important in modern wound care.
Dealing with bacteria.
Precisely. The effective disruption of biofilm and planktonic bacteria. Biofilm is this sticky protective shield that bacteria build. It makes them resistant to antibiotics, to everything. The multimodal action of EscharEx breaks that shield down, making the wound biologically ready to heal.
So you have this sophisticated triple-action therapy going up against SANTYL, an ointment that was FDA approved in 1965.
It's the classic David versus Goliath setup. SANTYL, despite its age, still generates $370 to $400 million in annual sales. But a key insight is that its original approval predates modern, rigorous FDA standards. There's a lack of high-quality clinical evidence for it.
So EscharEx is going up against a gold standard that might not be so golden under modern scrutiny.
And SANTYL is just a single-action therapy that often takes months and frequently needs to be supplemented with surgical debridement anyway.
This is where the head-to-head data from the phase 2 trial becomes the most compelling part of the story.
The speed differential is the central value driver. In the phase 2 trial, EscharEx achieved full debridement in a stunningly short time, 1 to 2 weeks, just 4 to 8 daily applications.
And SANTYL.
Typically requires 4 to 8+ weeks of daily application and often fails to get there even then.
Let's get to the specific numbers from that head-to-head trial.
They're definitive. In just 2 weeks, EscharEx achieved 63% complete debridement. The SANTYL group in that same period, 0%.
Wait, 63 versus 0?
63% versus 0%, with high statistical significance. But the critical endpoint is wound bed preparation, or WBP.
Getting the wound ready for advanced treatments.
Exactly. The median time to achieve WBP was just 11 days for EscharEx. For the SANTYL group, WBP was not achieved during the study period.
11 days versus never. That speaks for itself. And that rapid prep has to translate to faster healing and lower costs.
It does. The final result ties it all together. The average time to wound closure was cut dramatically, from 76 days for the SANTYL group down to just 48.4 days for EscharEx.
Almost 4 weeks faster.
Which means a much lower risk of infection, less need for specialized care, fewer hospitalizations. That's the health economic benefit that justifies the huge sales projections.
And the timing for this seems perfect, with some big changes happening in Medicare.
A massive tailwind. The new Medicare policy, the LCD, effective April 2025, is a game changer. It basically says Medicare now requires full debridement and granulation tissue-full WBP before they will cover expensive advanced treatment.
So EscharEx becomes the key that unlocks reimbursement for everything that comes after.
Exactly. It's positioned as the ultra-rapid, go-to first step in this new landscape. Given the 11-day WBP achievement, it's perfectly suited to meet this new regulatory demand.
The clinical data and market alignment are just. They're overwhelmingly compelling. So now that we get the product and its potential, let's look at the financials and the critical events that will decide the outcome here.
The financial health is what makes this whole high-stakes bet possible. As of September 30, 2025, the balance sheet was remarkably stable. They had $60 million in cash, cash equivalents, and short-term deposits.
And debt. In biotech, that's always a major concern.
That's one of the major strengths here, thanks to that government funding. The company has zero debt.
Zero debt.
And that $60 million in cash provides a financial runway projected to last into 2027, which comfortably covers everything they need to do to get to the big catalyst.
Which is that phase 3 interim data in mid-2026.
Right. And they are investing heavily to get there. R&D expense was nearly $10 million in the first 9 months of 2025, but that's being offset by the growing NexoBrid revenue,
which is projected to grow pretty fast.
Very fast. From about $20 million in 2024 to a projected $30 to $33 million in 2026.
And that jump is driven entirely by finally having the manufacturing capacity to meet demand.
It is. That 6-fold manufacturing capacity increase lets them finally fulfill existing commercial demand and, critically, meet the large-scale stockpiling orders from BARDA.
And more scale should mean better margins.
Absolutely. The gross margin is projected to increase potentially up to 65%, which just provides more internal capital for the future.
So the foundation is secure and it's growing, fueling this high-risk project. But all eyes are now fixed on that one moment, the EscharEx phase 3 data.
This is the moment of maximum risk and maximum reward. The pivotal value study is enrolling 216 patients. The entire long-term valuation of this company hinges on its outcome. And the key milestone is that mandatory pre-specified interim assessment anticipated in mid-2026.
So what's the best-case scenario for that interim look? What would that do to the stock?
The best case is an overwhelmingly strong efficacy signal. If the data is powerful enough, the regulators could allow them to stop the trial early due to demonstrated superiority.
And that would be a massive de-risking event.
It would fundamentally change the story overnight. It would move the investment from Iris R&D bet to a commercial launch story.
But we have to look at the other side. What if it fails? That's the big question.
And you have to. Acknowledging the risk is essential. The single largest risk to the entire upside is late-stage clinical risk. If the value study fails, the long-term thesis is severely damaged. The upside is gone.
But the company survives because of the NexoBrid floor.
The company survives, but the valuation would take a massive hit. Only EscharEx can deliver that multi-billion-dollar upside.
So given that huge risk, are there any signs of strong internal confidence?
There are. 2 powerful signals. First is insider buying. The chairman and the CEO both bought shares on the open market in August 2025 at over $17 a share. That signals strong internal belief.
And the second signal?
The persistent chatter around M&A potential. Larger companies are clearly interested. Analyst speculation is high, noting media reports of a rejected $34 per share bid back in 2024.
And there's talk of an even higher number.
Yes, talk of a potential $40 per share buyout, with the theory being that a strategic buyer would want to acquire the company before that high-risk, high-reward data lands in mid-2026.
Which brings us back to our central question. We have this secure, government-backed floor, strong phase 2 data, and enough cash to get to the catalyst. Does that floor justify the high-risk bet on the massive upside?
That is the core of the investment thesis. The final verdict comes down to balancing the stability of that foundation against the magnitude of the potential disruption. MDWD has a remarkably secure government-backed revenue floor with NexoBrid.
And that security is what makes the late-stage clinical risk of the value study a tolerable bet for investors.
Exactly. And success in that study is the key to unlocking that multi-billion-dollar ceiling. The valuation is tied directly to capturing significant market share from SANTYL.
Based on that superior clinical data from Phase 2.
Precisely. Because of that speed, that 11-day median time to WBP versus not achieved for SANTYL, the analyst models project a potential for $831 million in U.S. peak sales for EscharEx.
$831 million against a $2.5 billion market. That suggests if the Phase 3 data is positive, the current valuation has a very, very long way to run.
Indeed. The stock is a classic high-risk bet on a transformative technology. But the sheer size of that $2.5 billion chronic wound market means the reward, if that mid-2026 data is positive, fundamentally justifies the current risk.
And the existence of that government-backed floor is what makes the risk tolerable.
It transforms what would be a purely speculative biotech gamble into a financially hedged pursuit of market disruption.
That was an exhaustive deep dive into MediWound, summarizing the unique dual-use nature of their Bromelain technology. It's simultaneously serving military and national security needs through NexoBrid while using that capital and validated platform to attack a massive commercial market with EscharEx. We've established the secured financial position and the potentially transformative upside driven by that Phase 3 data expected mid-2026.
As we transition out, here's the final thought for you to consider. It's really about the conflict between innovation and entrenched practices. The evidence we have suggests that a clear clinical benefit, faster debridement measured in days, not months, can fundamentally disrupt a lucrative legacy market like SANTYL's. But clinical superiority often faces barriers. So as you see this process unfold, ask yourself, how much market share is truly captured by better clinical outcomes versus how much is locked in by legacy relationships, entrenched prescribing habits, and just the inertia of decades-old medicine? And how quickly can superior results really overcome that inertia?
Risk defined, portfolio protected.